Hey everyone, in this video I'm going to cover one thing that smart investors know about Carnival stock. So let's get right into the details here. So the big thing, the critical factor right now that smart investors are following about Carnival stock is debt, right? The company borrowed a ton of money during the pandemic when it needed to sustain itself and survive while its cruise ships were closed to customers. So it really built up its debt. Its long-term debt, in fact, right now is approaching $32 billion. So debt reduction for Carnival can increase earnings per share, right? In the most recent quarter that ended May 31st, Carnival paid 542 million of interest expenses. Annualized, that's over $2 billion in interest expense. So if Carnival can reduce that debt balance, it can reduce that interest payment. And I'm going to get into more specifics and more details a little bit later in the video, so stay tuned. In its most recent quarter, the company lost 407 million on the bottom line. So if it just reduced its interest expense, and I say this as if it's easy, but it's not. If it reduced its interest expense by more than 407 million, it would have been cash. It would have been positive on the bottom line. Now we also need to account for the tax deduction element of interest. But let's just keep it simple and say if it had 407 million less in interest expense, the company would have been profitable on the bottom line. So interest is a big portion of the company's losses right now on the bottom line. Like I mentioned earlier, it has 31.9 billion in long-term debt. Thankfully, the company generated 1.14 billion in cash flow from operations in its latest quarter. The company's revenue and customer growth is rebounding significantly since reopening economies gained momentum. So the business is doing well now in terms of customers and revenue. So this is the moment for Carnival to capitalize on that increasing cash flow to pay down that debt. And that's precisely what the company did in its latest quarter. I've heard some investors asking me about Carnival and its dividend. Should it resume the dividend payment? When should it resume the dividend payment? And my answers have been I think it would be more prudent for management to use the cash to pay down the debt. And here is why, because look how much debt is costing the company. And here is in more detail the company's interest expense. You see here 542 million in its latest quarter, 1 billion so far in the 6 months ended in May. So they will accumulate over 2 billion in interest expense if they continue at this pace for this year. Now, more interestingly, it's not all of Carnival's debt that is troublesome, right? So the company had billions of borrowings before the outbreak, and then it had billions after the outbreak. The troubling portion is the billions after the outbreak, because when Carnival went to lenders during the lockdown phase, lenders charged Carnival premium prices, high interest debt, high interest yields to borrow for Carnival during that time. Because why? Lenders looked at Carnival and said, hey, your business is shut down. We don't know if or when it will reopen. And so because you are a greater risk to us, we have to charge you higher yields. And so you could see here, Carnival on its balance sheet, what I have here, they have notes that they're paying 10.5% on, and they have debt that they're paying 4% on. So this 4% debt, I would not advise management to pay off. This is a relatively bargain price for Carnival. However, the debt that I have highlighted that I think they should pay off are the ones that are troublesome. This 10%, 10.1%, which they have $1.2 billion of this 10% and above rate debt here. If they were to pay this off, it would cost them 1.2 billion in cash, yes, but it would save them about 120 million per year in interest expense, or about 10 million per month, or about 40 million, 30 million per quarter, right? So that's a meaningful reduction. And then also this floating rate debt here, LIBOR plus 3 to 3 and 3.3% at 4 billion. Now this is especially risky because this is floating rate debt. What this means is that if interest rates continue rising like they have been over the last year, that means Carnival will have to pay a higher rate because the contract is floating rate. So when interest rates in the market go up, Carnival will have to pay a higher rate. So this is especially troublesome because it adds a layer of interest rate risk to the company. It's already a cyclical company, right? People go on cruises when things are going well. People do not go on cruises when they lose their job or when they are afraid of losing their job. So it's already a cyclical business. You don't want to connect that with risky debt, right? So you multiply your risk in that way. And then lower down here, they have another $1 billion of interest that they're having to pay 10.5% on. So I would say this is a big opportunity for Carnival to increase their earnings per share as the cash flow from operations comes in to opportunistically pay down some of this debt, and that will provide a double benefit of increasing cash flows for the company, right? Number one, the increasing cash flows is good for the company, right? More cash for the company. Number two, they can use that cash to pay down debt, which will then reduce the interest expense, which will then increase cash flow from operations in the future, or not cash flow from operations, but cash flow to the company in the future, right? So it could be a virtuous cycle feeding on itself. So that's the one thing that I think smart investors or savvy investors are paying close attention to with Carnival stock right now. All right, but that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.